Okay, here we are starting up on week 3. Today we're going to look into the income statement. As I have done throughout the class, before every video and before every lecture, just sharing a little bit of information about our First Nations people in Canada. Acadia University is located in Mi'kma'ki, the traditional unceded territory of the Mi'kmaq people, and there is a ton that we can learn if we invest the time about the Mi'kmaq way of life and the way of lives of our Indigenous people in Canada. We are all treaty people, and we have a responsibility to look out for each other and understand each other's cultures. So this week, encouraging you to take about 10 minutes to watch an incredible TED Talk by an Acadia student named Lara Hartman. Her talk is about missing and murdered Indigenous women. And in her talk, she speaks about the tragic loss of Indigenous women who are go missing or are murdered at a rate much higher than those women in the overall population. So disproportionately impacted there. She talks about that, and she also speaks about intergenerational trauma and kind of the concept of time and how success is measured across different cultures. So encouraging you to check that out. Next up, so our game plan for today, we're going to be talking about the operating cycle. I am going to talk about the income statement, how that works, and how it's the story of what we've earned less what we've burned. So our revenues minus expenses, a little bit of income statement analysis to give you tricks for your next party so you can just rock it. And I'll tell you a little bit about why I think it's a cruel world and how we account for transactions using the accrual method. So let's dive in. First things first, a little look into the operating cycle. And this is essentially the period from kind of cradle to grave of how a company makes money. So typically, kind of money doesn't grow on trees. If you can start a business like that, let me know. Happy to invest in it. Often, we have to purchase or receive goods from a supplier on credit. So they're kind of giving us an IOU, delivering us the products. We have to pay cash for those supplies. So kind of upfront, we're outlaying some cash. We're getting credit for goods in order to have products that we're able to sell to our customers. And then ultimately, hopefully we receive payment from our customers. So there's a timing difference that may take place between when we initially outlay cash to buy products before when we sell them to the customer and ultimately are paid for them. And this is what we call the operating cycle.
Gotta spend money to make money. The operating cycle is the average period of time required for a business to make an initial outlay of cash to produce goods, then sell the goods and receive the cash from customers in exchange for the goods. That's the operating cycle.
Who let this guy teach? So to give you a practical example of the operating cycle, I'll talk a little bit about the one that was in place at the Canadian Bacon Cookhouse, which was a restaurant I operated on the Halifax waterfront that sold delicious bacon-based sandwiches. And so we would, at the beginning of the week, buy a big order of food, so kind of buns, dill pickle chips, a lot of bacon, and we'd have to pay for that up front. So we had to pay our suppliers when those goods arrived. And then it would be usually a couple of days kind of before we would use up that inventory and sell the goods to the customer, and receive cash in return. So our operating cycle there was really short, kind of paid cash for the goods and then received cash usually within a couple of days of receiving and paying for the goods that we bought from our suppliers. So short operating cycle. There are a lot of businesses that operate under a way longer operating cycle. Think of the construction industry where kind of often there's a huge outlay of cash required to kind of build a building, and you're not going to be generating revenue from that for sometimes many years into the future. So be mindful of the operating cycle of a company and know a little bit about how it might work across different industries. Okay. Some super important assumptions that kind of underlie this operating cycle, and one of them is that of the time period, or what we call periodicity. And essentially, within a company, we get to pick the time period over which we measure our success. So for a publicly traded company, someone whose stock is available for purchase on a stock exchange, typically we would divide kind of the life of our company into a number of time periods. So we would measure our results year over year, every 365 days. And we would also be required to report on and measure our success every quarter, so every 3 months. Okay, so the time period we pick is important in terms of our operating cycle for our business and how we show results. We also have to decide, based on the recognition principle, when we should be recording the effects of operating activities. So when can and should we be recording transactions, and how should they show up on our financial statements? So I'll talk a little bit later about the accrual method of accounting and how we live in an accrual world, one of the fundamental assumptions about accounting. And finally, when it comes to the operating cycle and accounting in general, how we measure and recognize transactions in terms of the amount that's recognized is also super important. Okay? So there's a timing period in terms of when transactions are recognized, and then what and kind of how we recognize transactions is also super important. So that's a little look into the operating cycle. Just as a quick refresher here, when it comes to financial accounting, the big four financial statements are the income statement that we're going to be talking about today, telling us the story of an organization's performance over time, what is earned in terms of revenue, less what it's spent in terms of expenses, and what's left over. Hopefully we've got some net income there. We have the balance sheet that we learned about last week, and that's a snapshot of what we own versus what we owe at a given period in time. And we have the statement of changes in equity that's telling us how we've performed in terms of earning a profit for our shareholders, less what we've paid to those shareholders in the form of dividends. So how we divided up the profit. And finally, my favorite financial statement, the statement of cash flows, which tells us the story of where our cash came and went during a year. So those are the big four. And today, before we dive into the income statement, just wanted to give you a little bit of a heads up of how to actually find financial statements online. So they are pretty easy to find. Usually a quick Google search of the company name and the word financial statements is going to result in you being able to find financial statements either through a kind of aggregate website like Yahoo Finance, or ideally directly from the company website. You'll be able to find their financial statements, or sometimes we call it the 10Q form if it's a US company. That basically is a fancy word that the SEC uses to label a quarterly report. You can find financial statements usually in an annual report for a company, or often you can find them kind of directly under the investor relations or reports section of a company's website. Okay? So 10Q stands for the quarterly financial statement filing. Okay? So just Googling company name and financial statements or company name and quarterly report, you're likely to be able to find information about the organization of your choice pretty quickly. So let's get into the income statement here. The story of what we've earned, less what we've burned, and answers the question, on paper, did we make a profit? So you may hear this referred to as the statement of operations, or the P&L, which means profit and loss statement. Okay, and so it's telling us the story of how an organization's performed, whether they're profitable over a period of time. And it doesn't tell us necessarily whether that profit results in cash coming into the company. And I'll talk a little bit more about that later when we're talking about the accrual principle. Okay. So often what you're going to see with a publicly traded company, or particularly with a smaller company, is a period of time over which they measure their success called a fiscal year. So this is the period over which the company chooses to measure its results, and the period over which it's doing some of its external filings, like tax filings. So often you'll see organizations that rely heavily on government funding will pick a fiscal year that aligns with their key stakeholder, which would be the government of Canada or like the government of Nova Scotia. and government's fiscal year, so the period over which they measure their success, is April 1st to March 31st. All kinds of ways that you would pick a fiscal year. It would depend on kind of your key stakeholders, when your operating cycle is, how long your operating cycle is, and the major periods of inflows and outflows of revenue and expenses over the course of a year. So just know the word fiscal year means a 1-year period that the company is choosing over which to measure its annual results and report on them. Okay, so let's get fiscal. Back to the income statement. So the income statement is based on what we call accrual accounting. It is a cruel world. This is going to be one of those concepts that's really important to understand. So we have what's called cash accounting, which is a big no-no. That is basically where when cash comes in, we record revenue, and when cash goes out, we record expenses. Unfortunately, kind of in the real world, that's not a great representation of how a company is actually doing. So under accrual accounting, we recognize transactions when and they're recorded at the time that they occur, regardless of when cash is exchanged. So we're trying to match up transactions. We're trying to match expenses in the period in which revenue related to them is earned. So to give you an example of this, if I am the Halifax Mooseheads, a hockey team in Halifax, I may collect a ton of cash from my customer at the beginning of the season for season tickets, okay? But I haven't earned the revenue kind of associated with those tickets until my team has played the game and I've delivered that kind of revenue to the customer, okay? On the flip side, maybe I'm in the construction industry, okay? I'm building amazing homes, and let's say that I build homes kind of in advance for a customer, okay? And they don't have to pay me until the very end, and maybe even several months after they've moved into their home. So in that case, I've earned the revenue and I can record a transaction when I'm completed the home, okay? So I recognize the revenue when I've done something that gives rise to earning that revenue, okay? Not necessarily when I get paid, which may be several months after I've completed the project, okay? So in an accrual world, we recognize transactions at the time that they occur, regardless when cash is received. Okay. So a little bit of anatomy of the income statement or the profit and loss statement, the P&L, the statement of operations. I like to think of this as the country music song of financial statements because it starts off great and then gets worse and worse and worse as we go down. Okay, so we start off, the top line of our financial statement is called revenue. Okay, so that is formally an increase in the amount of resources an organization has as a result of providing goods or services. You may hear this called sales. And it's basically the inflows of resources to a company based on providing goods or services. Okay, so what are we selling? Are we selling a product? Are we selling a service? And revenue is reflecting kind of what we're earning in exchange for that value. As we go down further, we start to talk about expenses, and that is where we are kind of putting a number on the resources that are required for an organization to deliver the revenue or earn the revenue. So things like paying our employees, things like paying for the supplies that may go into making a good. Okay, so if I'm like Tesla, one of my expenses, if I'm building cars, is going to be the expenses associated with rubber to put on tires. It's going to be the components that I put into my stereo system, maybe a Bluetooth receiver, the engine of the car, also an expense. So I sell the car for a lot, and then I have expenses I need to incur in order to allow that sale to happen. Okay. At the bottom line of an income statement would be called net income, sometimes called net earnings, sometimes called profit, sometimes called the surplus. Lots of names for these things, okay? That's telling us over a period of time, maybe a fiscal year or maybe a quarter, did I earn more money? Did I earn more revenue than the expenses I incurred in order to make that revenue? So have I earned more than I have burned? Is my revenue minus my expenses greater than 1? Did I generate a net income? Okay. So slicing and dicing this into a little bit more detail. Top line revenue, that's an increase in resources for things that we've sold. You may hear this referred to as sales. And something you're going to want to do when you're looking at financial statements is to kind of dig beneath revenue, often it'll show up in kind of one line item on the financial statements. There's often all kinds of ways we could break that down. Maybe it's by kind of the product source. So if I'm thinking of a company like Apple, I'm going to have revenue from kind of selling iPhones. I'm going to have revenue from selling like subscription services. I'm going to have revenue from selling computers. So understanding what's going into that revenue by product or maybe by geography. So if I'm Apple, are my sales taking off in India and tanking in Canada? I want to know the geographic bounds of where those sales are being generated. Okay, so all kinds of ways we can slice and dice revenue. Important to understand what is kind of being housed in that revenue line item on our financials. Okay, so then we head on down. We start at the top line, revenue, the good news. We head on down into expenses, and that is where we're recognizing the costs associated with providing services. So we typically have kind of two broad categories for that. We have cost of goods sold, which appears near the top of the income statement, directly below revenue. And that's recognizing all of like the direct inputs associated with making a good. So as its name is, the cost of goods sold. So again, with like the example I used with Tesla, revenue is what we would earn from selling the car. Cost of goods sold would be the physical or out-of-pocket costs associated with building the car. So everything from like the windshield to the tires to the engine is included in that line item called cost of goods sold. Okay. And the next big overall category that we would deal with here is called operating expenses. And so those are things that can't be like directly attributed to that cost of goods sold number. So for Tesla, something like the salary for their CEO, Elon Musk, you can't necessarily trace that directly to each individual car. And so that would be what we'd call an operating expense. Sometimes might call this overhead expense. So these are like costs associated with marketing, costs associated with like operating our building that we can't attribute directly to individual products. Okay. So we break down our income statement in a number of different ways. We've got our revenue, what we've earned, and then our expenses, the costs we've incurred to generate our profit. Then we've got the bottom line that's telling us whether we have spent more than we make, and we just subtract our expenses from our revenue, and hopefully what we've got at the end of the day is a net income where we've earned more than we've spent. Okay. So really basic overview of the income statement. Let's get into analysis here. This is how you impress your friends and family next time you're kind of out at that big party, or you're getting ready for a big sporting event. Your game is in the championship team. You're trying to get the troops pumped up. Pull out a set of financial statements and say, let's analyze this income statement. And important when you're analyzing financial statements to measure what matters. So what's important to your key stakeholders, be it the owners of the company, the bank that may be lending you money, your investors. You got to know and hone in on kind of what metrics are important to them. So a couple different ways that we can analyze the income statement. I'll throw some big terms at you, and we'll cover this throughout the term. So we can look at a income statement. If we're looking at kind of year over year, we can convert every line item on that income statement. So like our revenue, each category of expenses, we can convert each of those numbers into a percentage of sales. We would call this vertical analysis or a common size analysis. And this allows us to understand kind of what components of our income statement are making up kind of the biggest proportion of our expenses as a percentage of sales. Okay? So if we're looking at things year over year, if the percentage of cost of goods sold as a percentage of revenue is increasing kind of year over year, it could be an indicator of something like maybe our supplies are getting more expensive, maybe we're building a higher quality product, or maybe we need to kind of look at an alternative supplier because costs are getting out of hand and we can't produce the product sustainably. Okay, so that's vertical analysis or common size analysis. Another simple way to analyze financial statements is to just carry out what we call trend analysis. So that's looking at kind of year over year or period over period. Have there been any big changes in a given account? So has revenue gone up or down period over period, or Have there been any big percentage changes, proportional changes of a given account, like cost of goods sold or salaries expense, proportionally relative to other periods? Have those changed up a bunch? And our very favorite, kind of easy to do, but super powerful, again, if you're looking to get that team pumped up, we can do some ratio analysis. So two big ratios we can rock with our income statement. The first one is called our gross profit margin, okay? So this is telling us basically after we factored in the cost of goods sold of our product, so taking our revenues and then factored in our cost of goods sold, it's telling us essentially what's left over that is getting contributed to our profit. Okay, so by figuring that out, we can essentially figure out how profitable our company is in terms of just looking at the relationship between like what we're selling and the goods that are going into it before we've covered off any other costs. So for that, we're going to just take our gross margin and divide it by net sales revenue. So that would look a little bit like you take your revenue less cost of goods sold, okay, is your gross margin, and then you're usually just dividing that by your net sales revenue or your total sales revenue. Okay, so in this you're looking for variances between periods. If this kind of ratio is changing a bunch between periods, and you're also looking at kind of how a company is performing relative to industry benchmarks. So I'd want to compare, like if I'm looking at quick serve restaurants, I'm looking at McDonald's, how they're comparing on this ratio versus Burger King. Okay. The next one I can use is a ratio called the net profit margin, where I'm kind of going down to the bottom line and I'm looking at, I just take net income and divide that by my net sales revenue, or just my total revenue. And it's telling us basically for every dollar worth of sales that we are generating, how many cents or dollars of that goes directly to our bottom line. So if I'm selling a Tesla for $100,000, for each one of those dollars, how much of it's translating into profit. Okay. Again, looking at big variances between periods, so big trends that have occurred in terms of our profitability, and looking at how kind of a company stacks up to other ones in its industry. So how is Tesla performing for every dollar of sales that Tesla has? How much profit are they generating versus a competitor like Ford? So we can use these similar benchmarks to compare companies across industries. Okay. In terms of like what's reasonable here, varies widely by industry. We've got a couple examples up there. So typically, like in the retail clothing industry, you would see the gross profit margin at about 50%, 49%. So basically, for every dollar worth of sales of retail clothing, about 50 cents of that would be made up of like the cost of the actual materials in the product. Okay. And then after you factored in all of the costs of like a kind of labor, working at a retail outlet, for every dollar essentially worth of sales that a company at a mall would have, realizing so a mall in the clothing industry, you're realizing about 8 cents in profit for every dollar in sales that you're generating. Okay. In the telecom industry, quite a bit different. So on that, basically for every dollar worth of sales that you are generating on like a cell phone bill or like via a cell phone company, for every dollar worth of sales you're generating, there's only about 13 cents to you in terms of costs of providing that service. So hugely beneficial for cell phone companies to pump out big volume, because for every incremental customer they have, their cost of serving them, the cost of the goods associated with providing that service are like pretty low. Okay, and their profitability often like a little bit higher. Okay. In restaurants, a gross profit margin of about 68% on average. So this one's super interesting, particularly in the context of the pandemic. So a restaurant, usually for every dollar worth of food it sells, about like 30% of that, or 30 cents on every dollar of sales, is going towards like the provision and paying for the actual food that you're eating. Okay. So for every dollar of restaurant sales, about 30 cents is going towards covering the actual cost of food. Definitely want to look at financial statements of your favorite restaurant to see how much they're spending on food. What's important there, particularly in a pandemic time, restaurants are usually only generating a profit margin of about 6%. So for every dollar of sales at a restaurant, you are only earning about 6 cents for every dollar. Okay. Where this is important, if folks aren't able to dine in at restaurants, increasingly relying on the services of companies like Uber Eats or Skip the Dishes. And those companies often charge 25 to 35% commission on sales. So if I'm selling something for $10 to a customer, if the customer's only paying $10, I'm paying Uber Eats or Skip the Dishes somewhere between $2.50 and kind of $3.50 to deliver that food for me. And so it just destroys that net profit margin, and I'm not able to make profit. So a lot of restaurants right now just getting by on fumes due to government subsidies. And so some big challenges for some of our favorite spots to grab a place to eat. So encouraging where you can to order directly from the restaurant and make sure that your hard-earned dollars ends up in the pockets of the people who are making the food and not some tech giant that's just skimming a bunch off the top. Okay. Bunch of questions we can be asking about the income statement. We'll learn more about these kind of throughout the course. Just good to kind of introduce them early here. So biggest question you want to ask, like, do we have a positive net income? So are our operations profitable? Okay. Another question we want to ask is about resilience. So is our revenue coming from a bunch of different sources, or are we relying on just one kind of product or just one service that's to generate revenue for our company? So like I look at a company like Apple, pretty resilient from a revenue perspective. They're selling computers. We've got a streaming service. Okay, we've got our iPhones. Revenue coming from a bunch of different jurisdictions around the world and a bunch of different products. Okay. We want to compare how our company's doing in terms of margins to other competitors or peers in our industry, and look at and analyze some of the big trends in key accounts like revenues and expenses. So are revenues improving or are they declining over time? Okay. We want to know when we're looking at an income statement, sometimes there'll be like a big one-time expense or adjustment, and we want to make sure that we've kind of factor that in when we're looking at a income statement. So at a time of COVID, for certain industries, I think the airline industry, if I've looked at the last 5 years of Air Canada's financial statements, and then I compare them to this year's massive dip in revenue. And so I want to put that kind of into context of a pandemic happening and kind of look at things in a kind of a historical context as well as in a future context. So is that dip in revenue a one-off piece, or is that kind of a normal event that is going to occur more regularly into the future? Okay. So in summary, an income statement is telling us the story of an organization's performance over a defined period of time, usually a quarter or a year. We always want to be on the lookout for any big kind of one-off events, and we want to have a peek at alarming trends and ratios by comparing our company to its own results in prior periods and to similar companies in similar industries. Okay. Something important to point out, much like the balance sheet, we've got like a classified balance sheet where we break things down into current and non-current. With an income statement, we've got what's called a single step income statement, where it's everything sort of lumped into revenue or expenses. Whereas a classified income statement is breaking things out like a little bit further and showing us things like the gross margin and the gross profit. Okay. And as you can see on the statement here, towards the top of a income statement, when we're rocking a classified income statement, we break out cost of sales separately from lumping that into kind of a broader expenses section. Okay, so at the top we've got kind of our gross profit telling us about the relationship between kind of what we're selling and the specific costs for building that product or service. Break that out separately. Then we've got operating expenses. So like, what are the ongoing costs that we can't attribute to like a particular product? So like some of our employees' salaries, some of our operating costs, like operating our building. And then we also break out entirely separately things that don't really relate to our day-to-day operations. So like financing costs, like interest we pay to the bank, doesn't really have anything to do with our kind of day-to-day operations. If I'm Tesla, kind I build cars, I pay my employees, and then finance is kind of down here. That's more of a decision of how I make in terms of how I'm going to operate my company. And so I would break that out separately to give our investors a little bit better information. And towards the bottom of our income statement, we will see how much we've made before income taxes. So if I just take my kind of all of my sales, less all of the expenses we've talked about so far, what's left over is going to be what's called my earnings before tax. And I'm going to calculate how much tax I pay based on my earnings before tax. So essentially, the more money we earn, generally the more taxes we pay. We've got in Canada what's called a marginal tax rate, and I'm happy to talk more about that, but the more you earn, the more taxes you pay. Okay. So back to this idea of the accrual principle versus the cash principle. So we're recording revenues when a good or service is delivered, and expenses are recorded when they're incurred. Doesn't need to relate to when cash is changing hands. So that exchange of cash is captured over on the cash flow statement. On the income statement, just want to recognize kind of when we've earned revenue or incurred expenses. Okay, so revenue, you better recognize, okay? And you can only recognize revenue when it's earned. Okay, so like, what does that mean? Bunch of criteria. Accounting's all about rules. You can jump into what we call the CPA handbook, kind of the Bible of all the rules we need to follow. But generally speaking, when it comes to when we're able to recognize revenue, it's essentially when we've transferred all the risks and rewards of ownership from the seller to the buyer. Okay, so when I've essentially delivered that service and the buyer now owns it. Okay, we got to know kind of what the amount of revenue we're talking about is, and it's got to be able to be kind of estimated reasonably. And we can't recognize revenue unless we expect that we are actually going to collect it at some point in time. So making a reasonable assessment of whether we're going to get it or not. A lot of companies get into trouble by booking all kinds of revenue kind of fictitiously, generating sales that don't really have a high likelihood of being collected in order to impress investors. So that's a big no-no. Okay. So looking at a couple different scenarios here, we will jump into this fictitious company I've created, a pharmacy in Wolfville called Where There's a Pill, There's a Way. Okay, so a number of scenarios in which we can earn revenue, and under the accrual method, there's different ways to account for them. So scenario one would be one where we receive the payment in advance from a customer for a service. So we'll look at the journal entries for each of these, kind of walk through so we understand what is happening. So in scenario one here, that's when we've received cash before a good or service is delivered. So someone walks into our pharmacy, hands us a $100 bill or a $100 e-transfer and they're buying 10 prescription refills, but we haven't delivered any of those pills yet. Okay, so the kind of entry that we would make, or the exchange that's happening there, is that we are receiving cash, which is an asset account. So we're going to debit it because it's going up. And we're going to credit an account called unearned revenue, which is a liability account. Okay. So we have received the cash. Awesome. An asset's going up. But we haven't delivered the service yet, or we haven't given the pills over that to the customer yet. So we have a liability to them, and we would call that unearned revenue or deferred revenue. We need to record on our financial statements that we owe that customer those pills. So there's a liability. In the future, we're going to have to part ways with those pills. So that's scenario number one. Okay. And at the time of the transaction, that's what we would record. So we would increase our cash because we received it, and we would credit our unearned revenue, which is a liability account. Following on this scenario, when we actually start to deliver those services, we would start to recognize revenue. So let's say we fill it kind of one prescription refill at a time. We would recognize $10 per prescription filled as revenue at the time that we deliver it. So we would be decreasing or debiting that unearned revenue account. So our liability is going down by $10 for every time we refill a prescription. And then we can recognize the revenue at $10 a pop for each prescription that we're filling. Okay. So we can recognize when we're debiting unearned revenue because our liability is decreasing, and we would credit our revenue because we can now recognize increase our equity, and increase our revenue to recognize that we've earned that revenue. Okay, so that's scenario one, when there's a payment in advance. Okay. Scenario number two would be just when there's a straight up cash payment. This is probably the easiest type of transaction. So someone pops in, we hand over they hand over $100 to us, and we hand over $100 worth of pills to them. Okay, simple journal entry here. So we're just debiting cash because we're receiving that cash. An asset account is going up, so that's debiting for $100, and we can book the revenue right away. We've already earned the revenue. We've given the pills, and we don't owe anything into the future. Okay, so we debit cash. We've got $100 in hand. Okay, and we can credit revenue. We've earned the full amount. We don't have any more obligation, and we can recognize that revenue immediately with no liability. Okay, so the third and kind of final scenario we're going to look at today is when cash is received later. So we've provided a service upfront, and we don't get paid until later. So let's say it's late in the semester. I'm looking pretty haggard, and I pop down to have some Botox treatment to kind of get these eyes up a little bit higher and kind of get that smile working. Okay, so this is a scenario where I would receive the service in advance, and I don't pay for it until later. Okay. So at the time that I go in to get that Botox injection, this is exciting times, the pharmacist is going to deliver that treatment to me. I get the Botox, okay? I got puffy lips, bee sting lips, looks great. At the time that service is provided, the pharmacy, the service provider can recognize revenue right away. They've already provided the service. They don't owe me anything. I've already got my beautiful lips, and things are going great. So they can recognize the revenue even though they haven't received any cash from me yet. And so the journal entry here is going to look like debiting accounts receivable, and because I now owe the pharmacy $2,000. They've done the service for me, and I've got an IOU to them that I'm going to pay them in the future, and they can recognize revenue, credit revenue by $2,000 because they have delivered the service already and earned that revenue. They don't owe me anything else. Okay. So that's what happens at the time of the transaction, at the time of the Botox. Later on, when the pharmacy collects the money, they would be debiting cash by $2,000 to recognize that they're receiving cash. So an asset account going up by $2,000 when they receive the cash. And then they'd be crediting accounts receivable for $2,000 to recognize that they have earned that revenue, and they're able to decrease that IOU balance on their balance sheet because they've collected that IOU. So kind of a transition between two different accounts. Okay, accounts receivable, money they're owed, is now being replaced with cash that they are actually owed and have received. So threw a lot at you there. That is the income statement. So a big equation here is revenue minus expenses, and that's going to tell us whether we made profit. Call that net income or net earnings. An income statement is showing us that what a company has earned or burned over a period of time. So what the revenue is less the cost associated with generating earnings over a period of time, whether it's a quarter or a year. We can use ratio analysis, particular gross margin and net margin, to tell us kind of the components of profit, how profitable our company is. And we always use accrual accounting, and we recognize transactions when they occur, not when cash is exchanged. Okay. So that's a wrap on our summary video for week 3, encouraging you to check out the problems that I've got posted and watch the walkthrough solutions if you're looking for a bit more guidance on how to complete them. That is all for today. I hope that you are enjoying this accrual world, and make it a great day. We'll see you soon.
Gotta spend money to make money. The operating cycle is the average period of time required for a business to make an initial outlay of cash to produce goods, then sell the goods and receive the cash from customers in exchange for the goods. That's the operating cycle.